Welcome everyone. My name is Max and I'm a software engineering team lead at IMC. And today I'm going to be focusing on the role of technology at IMC. So before we get underway, just a few housekeeping items that I wanted to take care of. So can we ask questions? Well, I wish you could. However, we are recording this presentation. So what I've done is included a few slides such as this one where I address common questions that I get when giving this presentation. And so if your question is in there, great. That means you're going to get your answer straight away. However, if it's not, please feel free to reach out, send those questions over, and we'll make sure we get to them as well. So what I will cover today is quite an extensive history on how we get to where we are today, and then share a bit more about IMC and the role IMC plays within the industry. Then after this, I'll do a dive into technology at IMC and sort of explore the different pillars that support IMC, namely software, data, and infrastructure. And lastly, I'd like to share some insights into why I love working here so much. So first, I'd like to start with some history. If we think about the prehistoric ages, we had to satisfy all our needs ourselves. So for instance, if we were hungry, we needed to hunt or gather, or if we needed clothing, we had to also hunt and get some kind of fur or for clothing and so on. And then a little while later, barter started. So a famous philosopher, Aristotle, once stated that every object has two uses: the original intended use of purpose, and then the use in barter when you exchange that object for other values. So one thing to note about barter is we need what we call a coincidence of needs. So what that means is that I need to want something that you have and vice versa. If we don't have anything that each other wants, then exchange cannot take place. So a little later, money arrived on the scene. So money is effectively a medium of exchange. So what this meant is that I'm willing to sell to you if you're able to basically give me the amount of money that I'm asking for. So what this effectively does is it helps to facilitate transactions. So we no longer are limited by this coincidence of needs, and that way a lot more basically exchange can take place. So a little recently, or more recently after barter arrived on the scene, coins came about. And in terms of what we're actually trading, there was some intrinsic value embedded within those coins. So if we think about gold coins, there is actually a small amount of gold in that coin that was valuable, and that's what we'd be trading. These days, it's paper money. They don't have the same intrinsic value. However, what we're trading or what we're using is the fact that we trust the system and we trust the value that represents. So a little more recent, setting the scene, so about 420 years ago in Amsterdam. So the Dutch East India Trading Company was one of the first, or founded one of the first exchanges in the world. So to this day, it is actually still seen as the first modern exchange. So effectively, they're a company that they had a lot of business and they wanted to have individuals able to trade stocks in that actual company. So they became publicly listed and formulated one of the first exchanges in the world. That exchange was actually founded in Amsterdam, and that is where our head office is today. So for me, this was actually quite a fascinating thing to learn, because I was joining IMC and I thought, well, why would Amsterdam be the head office of all places? And then so as any of the new starters that join, I went to Amsterdam for the first time as part of the global training program. And I took a recommendation of a colleague to take a walking tour around Amsterdam. And I actually went to the site where this exchange and the company was founded for the first time. And it was just quite a remarkable experience. So not long after this, in 1637, the world then saw its first asset bubble, which was named Tulip Mania. So effectively, tulips, a rare exotic flower. They were introduced into Europe from Central Asia during the Dutch Golden Age. And for one reason or another, these tulips became just heavily sought after and demand skyrocketed. And with that, the price of tulips also skyrocketed. During its peak, one bulb of tulip, if we think about it, was worth 1 to 4 horses. Now, after some time, people caught on and sought that one, well, this was completely unsustainable, and two, the prices were absolutely completely ridiculous. So all this then came crashing down, and that was where our first asset bubble burst, so to speak. So a key takeaway here is coming up with the value of something can actually be extremely difficult. So if we think about it, there's probably a number of different ways that we can explore this. So firstly, there's the material value that something holds. So if you think about a particular object, and we can look at the different materials that are required to actually build that object, we could just simply add the cost of all those materials together and say, okay, it's worth this much. But then there's also things such as sentimental value. So this is a special meaning for you or a group of people for this particular asset or object. So something like artwork, for instance, or an item that your grandparents own that have been in your family for generations. So this also has the potential to impact on how we value something. And of course, as we've seen in this example with the tulips, supply and demand plays a big role in determining the value for something. So here, we've illustrated that if demand is high and supply is low because that particular product or item is extremely rare, then this has an inflationary effect on the value of something. And conversely, if there's a lot of that item and it's ubiquitous and it's everywhere, well, then they tend to be a lot cheaper. And then lastly, something that might not be as obvious with this story, but there's actually the relationship between products that may also dictate or influence what the value of something may be. So in this scenario, yes, tulips were going crazy in terms of their pricing and their value, but potentially roses may have also been following suit, and not to the same extent, but also been changing in value as well. So this is a concept that we'll touch a little later on in the presentation. Now, I wanted to share another story with you that often comes up when we talk about HFT, and that is the Legend of Waterloo. So the English army defeated the French in Waterloo, and this is a place in Belgium. And at the time, there was a trader in London named Nathan Rothschild. So he was effectively a bonds trader. Now, it's a bit hearsay into how he got the information first in London. Some say he used horses, others say he flew pigeons there. However, he managed to receive that information that the English had won before anybody else did. So what he was then able to do was he bought British bonds, and clearly, they were going to appreciate as the English had just defeated the French. And conversely, he then sold French bonds because their values were going to decrease after the loss. And so this example, this story just already highlights that speed and knowing information can give a distinct advantage in trading. So in 1989, IMC was formed. So company has it, or company rumor has it, that the name was derived over a game of snooker. So effectively, a fun name named of a couple of different things, with the I standing for international. So now at the time, IMC was just a small, tiny office in Amsterdam, but clearly the ambition was there to go global from the get-go. Now, M stands for market makers, which is a special role that IMC plays within our industry, and this we'll touch on a little later in the presentation. And lastly, combination. So this is a bit of a play on words, as a combination is also a financial instrument that we can trade on an exchange, but it also is referring to a combination of people. So in this case, it could be the employees of IMC or a combination of market makers. So with exchanges, they already started to go digital. So this trend started to originate in the 80s, where bit by bit, piece by piece, what was being traded on the exchange went and moved into a digital form. So we can see on the slide here that on the left we've got our traditional sort of picture of a trading floor. We have all these floor traders who are going to be yelling and screaming to try and fulfill their need to buy or sell a particular stock. And over time, this has actually been transitioning to what we see on the right of this slide, which is a data center that's full of servers. And those servers are receiving messages to buy or sell particular stocks or financial instruments, and the matching actually takes place on these servers themselves. So in 2012, I joined IMC, And over my time, I've had a number of different roles at IMC. Initially, when I joined, I started as what we call a strategy developer, of which we'll elaborate a little bit on later on in the presentation. But effectively, this is just the part of our software that determines, well, hey, what is something worth? And then after this, I actually went to the global training program in Amsterdam. And upon my return, there was a need to build exchange connectivity out in APAC. And so from that point forward, I was working on exchange connectivity. And then this led me into working more in sort of automated trading and algorithm space, which then actually uses the values that came from strategy and then market data that came from the connectivity layer to then make decisions about what we should basically buy or sell and how we should trade. And then after this, I spent some time looking at basically our global risk limit framework that protects us while we trade. And once this global project was sort of rolled out and sort of tied to completion, I then spent some time actually looking at managing our trading system configuration and complexity. So if we think about how complicated and complex our trading systems can be, with that goes a lot of configuration. So it was mainly looking at how we can make that as well understandable, extensible, robust, and basically scalable as possible. And since that point, I then transitioned as an on-desk developer, similarly in sort of exchange connectivity and automated trading space, but specifically for the Hong Kong desk, where we focus and specialize in trading in Hong Kong. So time for a question. What motivated me to join IMC? So personally, I tend to think of myself as quite a pragmatic person. So I do enjoy learning theory and I find it interesting, but I'm always drawn back to, how can I use this in practice? Like, how can I use my craft to actually go and do something useful? So quite early on in my university career, I just knew that I didn't really want to go into pure technology and that I wanted to take the skills that I had learned and apply it to a different problem domain. So I ended up in financial markets, and I actually was working at an investment bank looking at FX trading systems. And at this point, it was more of a case of facilitating like manual trading and the processes around that, rather than actually like innovating the industry through the use of technology. So at a later stage, I then learned about companies like IMC, and effectively they had software and systems that were making these decisions autonomously and doing this in a really fast and scalable way, and that really drew me and was very interesting. So upon then transitioning to IMC, I was in effect joining a company where they viewed technology to be just as important as the trading strategies themselves, and that really resonated with me, and I haven't looked back since. So in this particular slide, we're looking now at 2020. So it's a photo of what more or less is an empty exchange floor. Now, as we look back, like COVID-19 hit during 2020, and in actual fact, they had to close the physical exchanges for some periods of time. And given that a lot of trading had moved digitally and had undergone that transition over this time, trading continued throughout the entire process and was unaffected by this closure. So in actual fact, the exchanges are almost more of a TV studio these days rather than where a lot of the traded volumes actually take place. So now that we've been through this brief sort of contextual overview, let's start taking a look about financial markets and sort of take a deeper dive into how financial markets actually work. And by doing so, I believe that we'll get a better idea on how then technology is able to help facilitate trading. So first things first. Well, I've mentioned it a few times. What is an exchange? Effectively, an exchange is just a place where buyers and sellers for a particular asset or product, in this case it could be stocks or some other financial instrument, is where they meet in order to trade, for an exchange to take place. And so as we've seen, they've sort of come a long way from being physical floor trading into mainly predominantly screen trading. But this is effectively where the trades happen. Now, I've definitely mentioned this word a few times so far, and that is orders. So let's take a moment to define what an order is. So an order, in effect, is the intention to buy or sell. And then it's doing this for a specific instrument, for a particular price, and a certain quantity. So that's effectively how much do you want to buy and sell of this instrument. So there are a number of different order types, along with sort of validities that go along with these order types. So let's just take a really quick high-level walkthrough of these orders, and that can help give us an idea of sort of their function within the exchange. So kicking things off, we have a market order. So a market order is a special kind of order whereby you don't specify a price that you want to trade at. So you're effectively saying, I want to trade at whatever the best price is right now at this very moment, and that's what is executed. Now, a limit order is an order which we typically think about more when we talk about orders. So this is actually now specifying a price so that I'm willing to buy up into a certain price, but no more, or I'm willing to sell down to a particular price, but also not any further. And then there's other order types, such as a stop loss, which effectively is saying, well, for now, I do not want to trade or to send any orders, but if the price moves past a particular threshold, then please send my order and I would like to trade. Now, those different validity types that I mentioned earlier on. So we've got a few different flavors here. So to start off with, there's what we call day orders. So a day order, as the name kind of implies, that it is valid for the entire day of that trading session. So if we put an order into the order book at that point, it will stay there being available to trade with other market participants until 1, it's completely traded out, 2, I've actually gone ahead and cancelled that, or 3, the trading session has ended and that order is then deleted on the exchange side. So then another flavor that extends this is the good till cancel order, or the GTC. So it's effectively the same thing. However, at the end of the trading session, it also then carries forward into the next trading session and the next until those other criteria that I mentioned are fulfilled. So either we cancel it or it's fully traded out. Then we have IOC orders, or immediate or cancel orders, which, it's effectively saying that for the quantity that I'm trying to either buy or sell, if any of that quantity does not get filled, please cancel it immediately and do not leave it in the book for others to trade against. And lastly, there's also a fill and kill order, which is effectively saying, I want to trade this entire volume, and if I can't get the entire volume, do not trade anything. So now all these orders effectively translate in the real world into different messages that are sent to and from the exchange. And so typically these are what we call TCP connections, so like end-to-end or point-to-point connections. So if you know a little bit about networking, this is effectively our own private channel to the exchange. And that way we're able to send our orders and sort of hear updates on the various events that happen with our orders in the market. So now that we've defined an order, another term that I've been throwing around is book. So also known as, well, basically an order book. So this is really the current state of affairs for a particular instrument. So it's all the limit orders that are currently resting in the book for that instrument. So in this example, I've just put the Microsoft stock symbol there. Prices are completely fictitious for the sake of the example. However, you will have a separate order book per different stock. So for instance, you'll have a separate one for, say, Canva or Atlassian or whatever the company may be, or whatever the financial instrument may be. And so what this is effectively saying is that these are people's intentions to buy or sell, and they're also happy to leave those orders in the order book for other market participants to trade against. So one thing to notice is it has two sides. So clearly we've got the bid side representing the intention to buy, and then we've also got the ask side, or the sell side, which is representing the intention to sell. So if we look at the image on this slide, this is typically what we look at and how we represent the order book. So if we're looking at the bid side in this example, we have collectively there's enough buyers for 800 shares that are willing to buy for $183.50, for instance, and then below that we've got then an additional set of buyers that are willing to buy 1,100 shares at $183.49. And then similarly on the R side, yeah, we have 900 volume that we're willing to sell, but at 183.52. And so you can actually see that the competitive prices are at the top of the book. So on the bid side, well, obviously, if we're willing to pay a little more for something, well, then we're then improving that price, or that price is becoming more competitive. And likewise on the sell side, if we're willing to sell for less, then those prices are going to be more competitive. So note that both the bid and ask side, during regular market conditions, they're not overlapping. Because if they were overlapping, well, that means there's actually a match of a buyer who's willing to buy at a given price and a seller who's willing to sell at a given price, and that's actually when a trade occurs. So that will typically not be resting in the order book. So now that we're familiar with the concept of an order book, I wanted to return to our concept of valuation that we started to explore during our tulip example earlier on, and sort of thinking about how much is something worth. So if we're looking at this slide and we're looking at the order book, we can ask ourselves and say, well, how much is one share actually worth in this example? And as with most answers in trading, well, it depends. So looking at where people are willing to buy and sell, maybe one way that we try and ascertain what the value is going to be. So in this case, well, we've got our bid price and our ask price. Well, maybe it makes sense to pick the middle. Like, let's say we pick the midpoint and say, okay, we think it's worth 183.51. That could be one way to explore it. However, if you're a buyer and there's no sellers that are willing to then sell at this price, well, then arguably, then the price it may actually be worth 183.52 because there is no way you could physically buy for any less. And vice versa, conversely applies on the bid side as well. So it actually depends on the context of what you're doing, whether you're buying or selling, which may influence what you see the value could be. There's also other strategies that could be put in place to try and get an idea on what this value could be. So if we, for instance, look at this example again in the order book, we've got 800 on the buy side, 900 on the ask side. If we just say that whole entire level traded out, well, there's still going to be a volume of 100 on the sell side. So there's going to be a surplus volume there. So that kind of indicates that there's actually more sellers in the market than there are buyers. So maybe the value is actually, a little closer to the bid side than the middle. So that could be a factor and something to consider. Other factors could include your own position. Let's just say you're holding a lot of these Microsoft shares. Well, you may not be interested in buying any more Microsoft shares. So as you're valuing what you believe it's worth, that will change that perspective as well. And then finally, there's also other aspects or angles which may not be that obvious by looking at the order book, but in terms of something like maybe Apple shares are on a large trajectory going up, and the whole tech sector is about to follow as well. And then this may mean that, Microsoft will be following, and that will also impact the value and valuation. So just to understand how the book works, let's run through a few examples where we'll pick some of the different order types that we spoke about earlier and see how they interact with the order book. So to begin with, let's start with, say, a market order where a buyer is really keen to sell and they're looking at selling a 900 quantity for this market order. Now let's take a second to think about what will happen given the current state of the order book. So the market order, given that it's basically saying executed at the best price available, will then actually get executed immediately. And it's going to trade through the entire first level there. So the 800 volume at 183.50 is going to trade. And then there's still 100 volume remaining of our 900 that we wanted to sell. So then there's also another trade, but at 183.49 that will trade at 100. Now, let's say there's another seller. However, this seller is not as keen to sell, and they won't sell for anything less than 183.51. But in this particular case now, the best buyer is not willing to pay anything more than 183.49. So then what's going to happen in this particular scenario? Well, note, so they're placing a limit order. So a limit order will remain in the order book unless it's either traded or cancelled. So considering we're putting a brand new order and it's not going to be cancelled, and the price of 183.51 does not currently cross what the best bid is. So it's going to be a new resting order that will remain in the order book. And so it's formulated that new price level there for other market participants to trade against. So now let's look at a buyer. And so we'll get a buyer come in who want to buy, what do we got here? Let's say 3,000 shares at 183.52, and they're going to do an immediate or cancel order. Again, take a moment to think about, so what will happen to the order book once this order is sent? So in this particular case, we can see that with a price of 183.53, we're going to trade out then the first volume of 500, that is on the top level. Then we're also going to go through and trade out the next level at 183.52 for the 900 volume. And then there is currently no ask level at 183.53. So there's a remaining 1600 volume, and which just gets cancelled. And so that's that IOC coming into play, where whatever we haven't traded just gets cancelled and no longer sits in the order book. So now if we take that same example and we just think, well, what would happen if that was actually a day order or a GTC order? What would the order book look like? So to elaborate that a little, that remaining 1600 quantity that we said would now be immediately cancelled, in this particular circumstance, that will rest in the book and actually create a new level of 183.53. And that becomes the new best bid price that buyers are willing to pay. So opportunity for another question. Do I need to understand finance? So there's actually no need to have finance experience prior to joining IMC. And the main reason is that IMC is very invested in training people and ensuring that you have everything you need to be successful in your role. However, one piece of advice that I would share with you is to spend some time and try and get some exposure, try and get a bit of a taste, if you will, of what financial markets are like. Because it is a bit late coming and joining IMC and then deciding that, well, I find financial markets boring, or I just don't like the finance world altogether. So try and spark your interest and get some exposure to it, and then that way you can make that decision for yourself. So there's no need to become an expert prior to coming to IMC, and here you'll be taught how to become that expert. So just to explore a little more context, so there are many types of different instruments on an exchange that are available to be traded, and without going into too much detail, I'll just quickly touch on a few that are on this slide. So there is one interesting thing to notice, that some products are actually made of other products. So they derive their values from other products, and we'll go into those in a second. So the product here that you're probably the most familiar with is a stock. Like, everyone's aware of what a share is, and you're a share in this particular company, so that is your stock. But then, as an example, there are other products such as an exchange-traded fund or an ETF, which is actually a collection or a basket of these stocks. And you're able to then, they have different amounts and weights they contribute to the ETF, and the value of ETF is actually the weighted sum of all these individual stocks. And so when you're trading that ETF, you're actually trading many stocks at the same time. And then we have options, which is a contract that gives you the right to either buy or sell a particular underlying at a certain price on a given date, and a few others on the slide, which you can dig into in your own time. So now we wanted to sort of step into, some of the fundamentals of trading here. So a key phrase that you'll hear often would be buy low and sell high. Like, sounds too easy and too simple, right? But if you think about it, this is typically on how we make money. Like, an investor, they'd go and buy something, they'd wait some time for its value to appreciate, and then they'll be selling it higher than what they bought it for. And conversely, the opposite also applies. Like, we could be selling high and buying back low and also making the difference. But then you might ask, well, how is that even possible? Well, to think of an example, you can say, let's just say your friend had a share and you decided to borrow that share off your friend. You could then go to the market, sell the share and then buy it back for a lower amount, and then return the share to your friends so they still own and have that same share that they were holding previously, but you've also made the difference in the meantime. Easy, right? Like, if you can continuously predict the future, we can just make money. Well, for those Back to the Future fans, I don't have a DeLorean time machine that's going to take us through and give us all the information that we need. So long story short, we can't predict the future. It's just as easy to buy high and sell low and lose tons of money. So then one thing that I wanted to point out and start exploring a bit further is this concept that we touched on earlier about related products. So studying the relationships between different products can then actually help us formulate a profitable trading strategy. So here I've enlisted the help of Macaulay Culkin to illustrate this example. So he loves cheese pizzas, and in this particular case, we've got three separate products trading on an exchange. We've got a pizza base, we've got some cheese, and we've got the actual cheese pizza itself. So with advanced research, I can find out that with one pizza base and 1 unit of cheese, I can get a delicious cheese pizza. So then what we can do is we can actually construct a second version of this cheese pizza. So what we kind of call a synthetic book, where we're effectively adding in the prices of the ingredients. So here, if we look at the bid price for a pizza base, it's $7.12, and we look at cheese, which is $3.85, we can actually then come up with a pizza for $10.97. And then the second thing we do is then take the smallest volume that's available, because we can't make more cheese pizzas than we have pizza bases or than we have cheese. So in this particular case, we've got the 20 volume from the pizza bases that we've taken. And so comparing this book of the synthetic pizza, we can then look for opportunities between that synthetic book and the cheese pizza product that's actually being traded. And so in this contrived example, we can see that the ask price for our cheese pizza is $13.73, and there's other buyers that are willing to buy a cheese pizza for $13.98. So what we're able to do then here is, for about 15 times, we can buy a pizza base, buy some cheese, and then sell a pizza and make 25 cents on each occasion. And we can do this with having a relatively flat position. So what this example is trying to illustrate, that rather than trying to predict the future, what we're effectively doing is trying to make money by identifying what the implied valuation between these related products are right now. And we do this in the present based on what the market is actually showing. So while this is a contrived example, there are numerous relationships between different products and financial markets where opportunities like this may arise. So for example, there's our option and the underlying product, constituents of the same basket. There's cases where you've got the same product on multiple exchanges, or the same product listed in different currencies. These are all real opportunities that you're able to then formulate trading strategies around. So let's look at another example. I wanted to pick an example that we're able to highlight and explain the role of a market maker in a little more detail. And an excellent example I've actually stolen from some colleagues, but is effectively an exchange currency desk at an airport. It's something that we're all familiar with. We'll go to the airport and we're going to be going on a trip and we need to exchange some money. Everyone's seen this at one point or another. So on the slide, I've also put what the exchange rate is on that particular day. But when we get to the currency desk, we see this, these sets of prices up on the wall. So one of the first things to notice here is there's actually two sets of prices. There's a bid price and an ask price. And these are different prices depending on what we're actually doing. So what currency we're actually converting and exchanging. So one thing to notice here, so if you're looking at the reference prices that we have, so say we look at the Aussie US dollar rate, they're willing to buy at 0.7535 US cents or sell at 82.35. Now, the current value is about 0.7856. So that's roughly in the middle there. So what the desk is actually doing is they're happy to buy from you at a little less than what something's worth, and they're also happy to sell at you for a little more than what it's worth. So they're not trying to invest, they're not trying to speculate, which way or which direction the currency is going to be moving. They're always trying to make money around what the current value is, buying low and selling high. So let's say we're at the airport now. And so we're on our way from Sydney to Hawaii, and it's what is set to be a fantastic holiday. So in this example, we're looking at changing our 1,000 Aussie dollars into US dollars. So when we get to the other end, we've got some US currency that we're able to use immediately. So we go to the currency exchange desk, we give them our 1,000 Aussie dollars, and then we get 753.50 back in US dollars. And then as we're sitting around, some sad news comes out, and effectively all the flights are cancelled for the foreseeable future. And so now, the whole trip has to be cancelled. So we figure, I don't want to have all these US dollars with me. I can't use them in Australia. So let's change them back to Australian dollars. And in this case, so we get our 753.50 US dollars, and when we convert them back to Aussie dollars, we only get $915. Wait a minute, we just lost $85. Great business for the foreign exchange desk, but what happened to your money? So one of the first things we can actually ask ourselves is, is that fair? Well, what they've done is exactly that. They've sold it to you for a little more when you're getting ready to leave and bought it back for a little less when you return. And so the difference between the bid and ask here is what we call the spread. And one way we look at this, it's effectively the fee that they charge for providing their service. And then you might ask yourself, what service are they providing? Well, what would happen if there are no currency exchanges? In this case, you're going to get to Hawaii and you do not have any US dollars to pay for your taxi or pay for food or whatever it's going to be. So they are providing you a service for your trip in this case. And secondly, there's also complete transparency. I mean, they're displaying all the prices clearly for you. And so they're not trying to hide anything for you there. So then you might think, is there any case that they're able to actually lose money? Absolutely. I mean, let's say after you immediately bought and exchanged your currency, there was a really sharp price spike or directional move in the currency that you acquired, and the rate improves in your favor. Well, when it comes time to then exchanging your money again, it's like, they must incorporate those differences in pricings into their rates, and you might actually make money, right? So whenever the currency desk then trades, they enter into what we call a position. So now they're holding, in this case, some of that currency, and their profit is actually directly tied to the direction that the currency rate is actually going to be moving in. So what they're doing is they're essentially taking on a risk there. So in order to try and offset some of this risk that they're taking, they will then try and make the difference, or take the difference around the value of what they're selling. So for the last part of this example, let's think about, what happens if there's another currency exchange desk that opens? Well, effectively, you're introducing competition. So now what that means is they're going to have to tighten their prices or tighten that spread, or it'll be as simple as you will not go and choose them to exchange your money. So that way they're actually incentivized to make the most competitive prices possible so that everyone comes to exchange their money with them. Because if we think about it, they can only make that spread if you actually come and trade with them. They can't make that otherwise. So the actual best outcome for the currency exchange would be to have an equal number of people that want to change their money on either side, in which they can then make that spread and actually carry no risk in the interim as well. And lastly, what happens if all the desks were closed? Well, clearly you're then unable to change your cash, which could be arguably worse. So very quickly, summing up a few metrics and a few concepts here, we've got what we call the bid-ask spread, which is effectively the ask price minus the bid price. And so this is what we call the cost of investment. Because as we've seen in our last example, if you then went and changed your money, changed your mind, there was a fee associated with that, and that's the cost of making that decision. And then we have the term volatility. So effectively, it's how much do prices move, and in this case, how much are currencies' prices fluctuating and moving. And so if a currency is in particular volatile, often the exchange desk is going to then widen their prices to try and give enough leeway that the direction that the currencies are moving in doesn't go outside of their bounds. And lastly, there's the concept of liquidity. So how easy is it to then buy or sell a particular asset? And so in this case, in the airport, if all the exchange desks are closed, well, it's going to be completely illiquid because you're unable to trade any currency. And if there's a number of different currency desks there, well, then it's very liquid. You're able to go and buy and sell as you wish. So that brings us to market makers. So effectively, it's the M in IMC. And so what we call a market is actually a pair of prices. So we've got our bid price, our ask price, and this is our quote that a market maker is then providing to the market, similar to the currency example that we just looked at. So market makers aim to provide a service to the market, which is effectively threefold. So to begin with, they're tightening the spread, so the cost of investment should go down. And as we saw and we think about it, market makers, they're competing with each other. So we're only able to make that spread if we can get your trade. So effectively, they have to be very competitive with their quotes. And the way market makers are able to do this is if they are very confident with what their valuation is, so what they value the particular product to be worth, and that they're actually able to update their prices very quickly. Secondly, market makers aim to provide stability during volatile events. So if we look at our tulip example, for instance, like when there's these extreme events where there's a large emotional response, then often people are pulling their orders, prices are fluctuating all over the place, and this emotional response sort of feeds other emotions, and it gets into this spiral. Well, fortunately, computers and models and algorithms don't have feelings, and so that they still try and look for those key fundamentals during these large events, and then with the aim of pricing around this, and this should provide stability during these periods. And lastly, this leads to one of the main services that we provide, and it is to provide liquidity. So whether you're buying or selling because you want to invest or to speculate, there will always be a market maker that will be there able to trade on either side. Market makers do not simply buy because we feel that the market's going up or sell because we think it's going down. They're always willing to trade on both sides. Now, being able to, as we've seen, provide these competitive prices does rely on us being, being confident and being quick to update prices. So who else is there in the marketplace? Clearly, there's other actors involved. There's banks, there's funds, of which you can have a few flavors, such as investment funds or hedge funds. And your investment fund will typically be buying and holding, whereas a hedge fund is just going to do whatever it takes in order to give the return to their clients that they need. And then you have retail investors, such as you and me. And all of these participants' timeframes are actually quite different. So they are looking to get into a position and hope it moves in their favor. So actually having a market maker to trade with provides us ease of trading. So again, this is coming back to this liquidity concept. We then have, being able to buy and sell when we want to is actually really important. And having a lot of markets available and having good competitive prices then also lowers the cost of investment. So time for a question. One we often get is, well, do you work with traders? And as a developer at IMC, it's almost a given that you'll be working with traders at one point in time or another. I mean, if you think about it, they are the end users of our software and systems that we're designing and putting together. And how much your role, when it comes to working with traders, it's like how much your role involves working with traders may differ depending on your team. So from my particular standpoint, like my team is responsible specifically for looking after execution for our Hong Kong trading desk. And so each market has their own nuances, their own requirements, their own exchange protocol. So here it pays to specialize. But as you imagine, we work with traders daily. I mean, we're going to be collaborating on new ideas, effectively rolling out new features or larger projects, helping operationally, troubleshooting, firefighting, and so on. And so with this, like being part of the trading desk is actually really rewarding because you can then receive immediate feedback in terms of like what you've been working on, your contribution, and you can, one, see it in action, but you can also then get that same sense of accomplishment when the desk improves and achieves their goals. So to wrap up this section of the presentation, I wanted to address then the key question. So how does IMC make money? So as I've alluded to earlier, it's all about buying low, selling high. And the way we do this is by sending in quotes and providing competitive sort of bid and offers there. And those bids and offers that we provide to the market need to be competitive in order to have participants trade with us. And so as a company, we actually don't have any clients. So we're not investing in someone else's money or or we're not selling a service to somebody. We're just participating in the markets and providing that service and trying to do this as well and competitively as possible. And so what makes IMC successful? Well, probably one of the first main points is the way in which trading and technology collaborate together. You're effectively getting trading experts on one side, technology experts on the other, and when you get this collaboration where the sum is actually greater than the parts, that's definitely what makes IMC successful. And to take this a step further, just having talented people that work really well together. Like it's not just about having talented traders or developers. IMC is a high-performing organization that has talent across the boards. We've got a great legal team, HR team, business development team, and so on. And it's really the way that all those different teams pull together to then achieve success. And then a key point is definitely about being then faster than the competition. Like as we do things, we always want to do things fast. And now that, like the obvious example there is say, well, okay, in terms of our systems, like if they view or see a particular opportunity, it's like, yes, we want them to react the fastest and capture these opportunities before competition. But it also then applies in terms of idea generation and the work we do. So we want to be extremely fast in terms of having an idea from whether it's a developer or a trader or whoever it may be, and getting that from inside their head into production as quickly as possible. And that time to market is also really what makes the firm successful. So now that we've developed our understanding of the evolution of financial markets, we've got a decent idea about market dynamics, and I would like to start taking a look and dive into technology at IMC. So an analogy that's commonly used is that of a Formula One car racing team. So in such that the trader is like the F1 pilot. They're effectively the expert of the trading domain who's on the front line, who are using the sophisticated F1 car built for them to win the track and be successful. It's like they know what we need to win. And then when it comes to the technology teams, they're like the F1 support crew, where they're collaborating together to engineer this, complex, sophisticated, fast trading machine that's part software, hardware, networking, infrastructure, all pulling together to give the trader the tools that they need to be successful and win. So in tying off this analogy, we're effectively engineering a high-quality, fast F1 car that's capable of winning the Grand Prix. And technology at IMC consists of a number then of key pillars which make this a reality. And we'll just dive in and have a really quick introduction to each of these over the coming slides. So first things first, software. So the software stack is, I guess, divided into a few key concerns or key areas. So to start with, we've got one part of that stack is we label strategy. And you say, well, what is strategy? So the strategy stack's all about ascertaining or determining what something is worth. And so it has a number of different pieces of code, algorithms, and components that would be analyzing the markets in accordance with these algorithms and trading models. And most of these are actually being designed by traders and quants based on data. And effectively, it's more like the brain of the operation. So mostly and historically, the strategy stack is in Java. I mean, there is different bits and pieces of Python floating around, in particular where there's interaction with traders, as Python is a really nice language for traders to work with. And then we have the execution stack. So to take this F1 analogy a little further, the execution stack is like the muscle of the operation. It's where performance is critical, and the real main purpose is to be able to get the trades we want. So effectively, the strategy will come up with the valuation, and then we want this tight loop of getting this valuation from strategy, getting market data and different events and information from various other sources, and having the execution stack look at all these inputs and determine, well, hey, is there an opportunity that I want to be a part of, and ensure that we send our orders and try and capture those trades as quickly as possible. And so this part of the stack, naturally is mostly written in C++, and there's also some FPGAs sort of on the end in the tightest part of the loop that literally needs to be as fast as the speed of light. So performance here is clearly an important objective, and naturally is kind of a different problem space to solve in versus say the strategy stack. And then we also have a number of software surrounding this entire system. So we say support here, but there's a number of other systems that are looking at, trade reporting. So like, what are all my trades that are currently incurring, and like, what's my current position, and how much money am I making? And also just managing risks. I mean, as we've seen with trading, and as prices and values are moving around, as we trade, you incur risk. And so we want to ensure that we're taking calculated risks and managing this accordingly. And so we also have a lot of our skills working on these frameworks as well. So the next pillar of our technology teams is data. So data, I mean, why do we care about data? How does it fit within the world of trading? I mean, our data can effectively be broken down into two main focus areas. So we've got the analysis of markets and also the analysis of performance. So if we think about the analysis of markets, so we've got a lot of data in terms of how are markets moving, how are market participants reacting, in terms of recognizing particular patterns or events, how markets reacted during those events and recognizing patterns there, backtesting strategies and ideas. Like, all of this analysis can only be done with quality data. And then so with that, a lot of the analysis that spends time looking at these key areas feeds back into our strategy system and how we design and iterate and move forward with ideas there. And then secondly, there's the performance side of things. So it's understanding in terms of whether it's external exchange structure or just the performance of our own systems. We're looking at our system performance and just knowing basically how they're performing and what we can do there. So when we're looking at performance with our systems, there's a number of metrics that we tend to look at. So we've got our what we call wire to wire. So that's effectively the moment that a network packet arrives into the IMC network to the moment a reactionary packet for that opportunity is then sent back to the exchange. So that we call wire to wire, and we're also able to decompose that into the various parts along that path, and that way then we're able to see like, well, where could we optimize or be more efficient about what we're doing, and get a better idea there. And then another common metric is also hit rate. So for every opportunity that we see and we send orders for, how many of those opportunities do we actually capture? Or how many of those actually go to a competitor? And so naturally, we're kind of seeing here, like when we're analyzing performance, a lot of what we find here is then going to feed back into the execution system and ensure that it can be then the fastest and leanest as possible. So in terms of technologies that are used in our data space, it's a bit of a buzzword bingo. So there's just a lot of technologies here, but a lot of them are quite established. So we're heavy users of Hadoop, Dremio for SQL-like access. We've got Spark for running jobs on clusters, Kafka for messaging, and there's other kind of stores depending on what the requirements are. So for instance, it needs to be searchables. We've got Elasticsearch, and then also Kubernetes to ensure that a lot of our infrastructure and components that we're running are scalable and replayable and sort of well managed. So the last pillar here that we're going to explore is now infrastructure. So we actually have tons of data centers. So we'd actually like to say that we're probably in more data centers than Amazon and Google, which is kind of right. Like if we think about it, Google and Amazon, like their business is to have a few huge data centers where they're able to build them from scratch and control absolutely everything in that environment. Whereas for us to fulfill our role, we want to be as close to the exchange as we can, as light can only travel so fast in a cable. So any additional distance that we have to travel is actually just wasted time. So for our use case and for our purpose, we have co-locations, which are data centers, which are provided by the exchange. So that way we can be as close to the exchange as possible. And because we're trading in so many exchanges and locations, we're actually in just so many different data centers. And with that, we have tons of different servers that we use depending on sort of what we're trying to achieve and sort of what is going to be deployed running where. So another common question is, well, what is HFT? So HFT essentially stands for, well, high frequency trading. And as the name implies, it involves doing a large number of trades quickly, and the focus is trying to perform a lot of these trades and have a position as flat as possible, minimizing the risk that you're carrying. And in order to achieve this, algorithms and sophisticated software and hardware setups are required. So to do this as fast as we would like, we use hardware FPGA cards, where a lot of the code is written in a hardware language and then flashed onto an FPGA. So we're also very judicious about what we decide to implement in FPGA, as it is much more difficult to write code for an FPGA than it is to write, say, Java. So where we typically look at using FPGAs is where we get the best return on investment. So for example, if a certain market trigger is seen where the price is lower than what our current valuation is, then we want to be able to send a buy, as quickly as possible. And in actual fact, it's quite fascinating with the FPGAs. Like even the way the light travels through the card may then dictate where you can place certain pieces of logic on the FPGA board as it impacts latency. And the last part of our infrastructure is network, of course. I mean, we spoke about the example earlier on in the Legend of Waterloo in terms of the advantage having speed and timely information can have, and it's definitely still an advantage in our setup and in our business. And so these days there are a lot of related events happening in different markets around different places around the globe, and we want to be able to disseminate information as fast as possible. And an interesting story on this point, actually, there was a company called Spread Networks in Chicago, and they realized that, hey, well, there's a number of products that trade in Chicago that are also being traded in New York. And then they thought, well, there's a number of high frequency trading firms that rely on this information daily in their trading. And if we are able to then construct a cable that is going to send and distribute this information faster than any current existing solution, then it'd be very lucrative for all of the other firms to come and start using their network instead. So they started digging holes through mountains, laying all this cable and doing all this work. And in the meantime, there was another company, McKay, that started installing microwave towers. And of course, microwave towers were as straight as possible with a radio length apart. And by the time the spread networks were actually able to complete their cable, McKay had already had an RF link there, and the whole thing became a moot exercise. One more thing on this is the networking side is also extremely important, as you could have this really fine-tuned software and hardware stack, but a slow network, or vice versa, and the two really need to be aligned in order to achieve the best results. So then another question we typically get is why do we need to be so fast? Well, we've touched on this a little, but we can only provide really good and competitive prices if, one, we're confident in the valuation, and the other part of that equation was being able to update prices quickly. So whenever I'm willing to send a price to the exchange, I can only give a price that is going to be as good for the time it will take for me to be able to update it. So if we think about, what would happen if in the meantime I've sent this really competitive price and the market has suddenly moved, and even if I send an update immediately on my price, it's going to take 10 seconds to get there. Well, one of my quotes that I've sent is going to be completely out of the market, so that won't even be of interest to anybody. But the other one is actually going to be extremely competitive, so competitive that everyone is going to want to trade it, and I'm going to lose money on every single trade and then be stuck with this position and risk that I need to manage. And as a result, some speed is completely important there. And secondly, a lot of exchanges have what they call price time priority. So if there's a number of participants that want to be trading a particular volume at the same price, whoever gets there first wins. And as we saw with our examples, market makers need to capture trades in order to be profitable. So it's not purely out of a love of speed, but it's a necessity. And given the way the exchanges work, that if we want to be profitable, we need to be fast. So lastly, just wanted to spend some time sharing with you why I love working at IMC. So there's actually a lot here to try and decompose, so I thought I'd try and pick out some of the most notable things for me, and the first one that came to mind is company culture. Now, company culture in itself is a bit of a buzzword, and everyone can think about, wow, what does that actually mean? That's a really good point. But with that, for me, there was a few key areas that stood out. So one of those is entrepreneurial spirit. So we're a mature company. We've been around for over 30 years. However, just the way we operate and what we must do in order to remain competitive is just we must be continuously finding new and improved ways of doing things and innovating in order to basically remain competitive. And for me, this actually directly influences development and my role. So if at IMC, you're not just responsible for writing code, you're effectively responsible for just your entire software and the entire system. So this is then everything from your ideas to your design, implementation, testing, verification, rolling it out, firefighting, supporting its actual evolution, and basically everything there is involved with that. And this is extremely rewarding, and it makes the role highly dynamic. Secondly, the key thing for me is people. If I refer back to our F1 team analogy from earlier on, at IMC, we really recognize how important everyone's role is in terms of having a winning F1 team. And I kind of alluded to it earlier, but we believe in having staff performers in all roles. So legal, HR, business development, technology teams, and of course, our traders. And we really are one team, one dream, and we work really well together to achieve great things. And following on from this, that brings, for me, team spirit. So it's one thing to just be able to, rely on your colleagues to pull through no matter what and when you need them the most. and the fact that they care about your success and the success of the company as much as you do. So that's one aspect of it. And then in addition to this, like not only do we achieve great things together, but it's really rewarding Thingo and celebrating our achievements together. And at IMC, we have a lot of fun events, from drinks to parties to family days to an annual trip away, which is a highlight for me every year, and it's a really remarkable experience. And this photo on this slide is actually probably a photo from one of my favorite weekends away when we went to Hamilton Island for the weekend, and it was just, it was superb. In addition to this, for me, I just think the environment is just so dynamic and fast-paced. I think it's very difficult to replicate anywhere else. And I mentioned in my previous slide on the company culture, we're talking about this entrepreneurial spirit, and this completely dictates sort of how we approach development. So we do it in a way where, hey, we need to get and deliver to the market as quickly as possible. So how do we get sort of the MVP, the minimal viable product to market, so we can get immediate feedback and ensure that what we're doing is actually on the right path and that we don't need to change tack earlier. And we'll just go through this process and we'll say, hey, next MVP, next MVP, next MVP, and iterate really quickly. And so that is obviously a quite dynamic, fast pace, extremely rewarding and immediate feedback. And then the second part of that is actually the users of your system. And so, the people that are using all of your hard work are actually your colleagues who you're really good friends with. And for me, a lot of the work that I'm doing on a day-to-day basis is actually for the Hong Kong trading desk. And so on any given day, I just walk around to the Hong Kong trading desk, and you can actually just look at their screens, and sitting on those screens is your work, is your software, and we can start discussing how it's performing, how we've solved the new problem that we the feature we just developed, how that's going, how successful it's been, what are the pitfalls, what should we do differently, and sort of and iterate with that. And you're receiving this feedback in person, and that's your product that you're designing and making, and it's just really, really rewarding. One way I tend to look at it is like at IMC, you're a big fish in a small pond, and by that I mean just even as a developer, you can have an enormous impact on the business and what we're doing. And so lastly, this actually is what makes our roles at IMC so dynamic. Like, I could be doing anything from day to day, and designing, development, troubleshooting, firefighting. It's just very dynamic, and then for me that just resonates really well. So, last question: what skills or experience do I need to be successful at IMC? So before I go into these, I mean, clearly, please, if you want more details, go online and have a look at the various job openings that are there, because they're going to have a far more detailed description. But to run through a quick high level and kind of what we're looking for. So in terms of degree and education, well, we're interested in clearly computer science, engineering, mathematics, technology. And then in terms of experience, well, that's going to vary depending on your role, but we're effectively looking at some technical experience that is going to be related to your specific role. So in the case of, say, a site reliability engineer, like we're looking at Linux, Python, and sort of bash scripting skills. For software engineering, like be really proficient and capable in say Java or C++ or both. In terms of hardware engineering, we've got like Verilog, VHDL, or any other RTL programming languages there. And then for me, that forms one part of being successful here, which is your technical bench essentially. And then on the other side, I actually think these other characteristics are also very critical in being successful and having a large impact at IMC. And so with that, like, we're looking for avid problem-solving abilities and analytical skills. Like you're driven, highly motivated, resilient, so that when you face these really complex challenges, you're going to dig in and get through and deliver no matter what. Fast learning and adaptable. I mean, I've been here for 8 years and there's still just so much I don't know. And the longer I hang around, the more I realize I actually don't know. And lastly, if it wasn't obvious from a lot of the things I love about working here is teamwork. There's a lot of collaboration and you get to work with a lot of people. So the ability to work really well in teams is really important. So that brings us up to the end of our conversation. In summary, I mean, we talk about financial markets, how they work, some market dynamics, and the role IMC plays within financial markets. And then we've also explored, in terms of how technology supports IMC in being the best market maker and sort of beating the competition. And then we've had a quick overview of sort of our various pillars of technology. So we've got, our software, hardware, data and infrastructure. And we've clearly seen that, all of that has to both be smart and fast. And finally, I've shared and talked a bit about why I love working here. It's that entrepreneurial work hard, play hard, and the dynamic, fast-paced environment. So as mentioned at the start of the presentation, I mean, clearly I haven't been able to take any questions during this talk, as it is a recorded lecture. However, please jump online, send through your questions so we'll be able to discuss them as well. Thanks for joining.